Hey, happy Friday. Happy end of the week, everybody. Glad to be here with you. Doing market movers today. My name is Brent Moores. I'm sitting in for Ben Watson, who's out at a workshop right now in Dallas, actually. But I'm glad to be with you. I'm also glad to be joined by my friend Mr. Cameron May, who's helping me out in the chat today. And this is our final webcast for the week here. So we're kind of putting a book into the week, and we're going to talk about what has happened and what's going on in the markets and what's potentially coming in the markets as well as we go forward. Just a reminder, you can follow myself or Cam on X at BrentMooreCS at Cameron May CS. And also, just remember the information we're going to go through today is for general informational purposes only. It's not a recommendation or personal investment advice. And just remember, I don't know if we're going to get into options today, but remember they do carry a high level of risk and are not suitable for all investors. The paper money software application, that is for educational purposes only. Schwab does not recommend the use of technical analysis as the sole means of investment research. Commissions, taxes, and transaction costs are not included in this discussion. All investing involves risk, including the potential loss of principal there. There's no guarantee a stop loss will execute at or near the stop price. What are we going to do? We're going to talk about the general trend of the major market indices. What moved the markets this week? How are portfolios impacted? General time frames, different time frames, general trends in different time frames, support and resistance areas. We're going to get to that. So that's coming up. Here we go. This is the Thinkorswim platform. This is the S&P 500. And let's just talk about where we're at, because I think it's pretty significant what we're looking at right now. Of course, by the way, just to orient yourself on this chart, I have a 20-day and a 50-day moving average. We're above the 20, that's in red. We're below the 50, so that's a potential resistance level. But hey, the 20 was a potential resistance level too when we poked above that, didn't we? Additional resistance levels were the trend line. I have this kind of in a pinkish color on this graph, the trend that we had. Well, we're above it. You know, my colleague, Mr. Kevin Horner, often talks about, what sometimes referred to as the Horner rule of staying in, of not being so confident about a breakout until it stays there for 3 days. Here we're a day above that breakout level right now. Okay, so one day does not necessarily mean that we're stuck. It's going to stay above there, but look, it's got to start somewhere, doesn't it? So additionally, if we were to talk about, as we're talking about kind of support and resistance levels, I would say this is a potential level that was a support level, kind of resistance, and we're peaking just a little bit above that right there. So we'll see if that holds going into Monday. In terms of today and how we closed the day, I haven't looked at this for about a half hour, so we'll see. Did we hold up? Yeah, we actually closed on a fairly strong note, and that for most investors, that is a positive sign going into next week. Now, of course, the market is moved by a lot of different things of news, and whatever we have technical wise ending up the week is far from any guarantee that we're going to be there next week. But that's what we like to see on these. And a close near the high of the day is another thing. Now, I want to flip out in terms of time frames here. I want to go to I'm just going to flip on a 3-year chart real quick, because I think there's an important level that we can also see here if we pull up the Fibonacci retracement. If I pull up the Fibonacci and I go from the low that we had back in, what was that, October there of 22, up to our high and pull that there. Here's our Fibonacci levels, and I'm just going to zoom in just a little bit here just to give us a little better view. You can see the low recently, about 2-3 weeks ago, our low kissed right off of that 50% retracement level. These Fibonacci levels can act as support or resistance. In this case, it seemed to act as a support level. Well, look where we're at right now. We're right at that 23%, which is truly a Fibonacci level. 50% actually is not a Fibonacci level, although it's traditionally commonly used when we pull up Fibonacci levels. 23% sure is one, and that is kind of right where we're at right now. So that'll be kind of interesting to see where we go from there. Okay, so that's what I wanted to show on that S&P 500. But I also want to talk about, you know, the S&P 500 is not just, is often kind of heavily weighted by some big companies. But let's talk about this. This is the percentage of companies that are above their 50-day moving average on the S&P 500. We got down to a low of 4%. That is a pretty bleak number, to be very honest. That was very low, 4%. We're now back up to almost a third of companies are above that 50-day moving average right there. So that's what that number on the right would show you there. So that's a good thing there for you. And so, you know, that's we're seeing a little more breadth participation here. You can also see what's happening with volume on the S&P 500. Now, this is a chart that you can pull up if you want, $T VOL SPC for total volume on the S&P 500. I can't get into ETFs here right now. Sometimes people will use ETFs to try and track volume on indices, since there technically isn't a volume on an indice. This is just tracking the volume of the individual stocks on the S&P 500 here. But you can see when things kind of got all crazy, that's, you know, you saw those. Now our volumes are a little bit back more toward a more normal type level. Still a lot of volatility in the market, no doubt, but in terms of volumes, maybe a little less panicky. I think we could see that reflected in the VIX. VIX, we're down to 25, okay? 25. So that, by most measures, 25 is still relatively high, but it's certainly better, it's certainly lower than what it was. By the way, that VIX is on the S&P 500. If you want, we can also look at like the VIX on the NASDAQ. Right? Well, the NASDAQ tends to be more volatile than the S&P 500. So instead of 25, we're at 28, but that's come down nicely as well. And in case that on that T-vol chart, why don't some, or I don't know, that's kind of a weird thing. NK just observed that. Why is this off? That's just a display issue. I don't think, I don't know is the answer, I guess, is the true answer to that. I'm not sure why it's doing that. Okay, so that's where I want to start off. Now we can look at the NASDAQ, but really things are going to look fairly similar on the NASDAQ. If we draw that trend line, this was an old, I don't know what that was actually, to be honest. Let me activate that drawing. Let's go to that. We've broken above that trend line there that we had on the NASDAQ. We're above the 20-day moving average. Here was that level, kind of the corresponding level of support resistance on the NASDAQ. We're a little bit above it. So the chart on the NASDAQ looks the same there on that. Here's the Russell 2000. Again, we've broken above what I'd probably deem to be a pretty key resistance level. And we've actually stayed above it a couple days. So that's a good sign. But one thing to always keep in mind on the Russell 2000 is it got beat up more than, small caps got beat up more than large caps in, you know, as a whole there. So that is, you probably expect when it recovers to recover to a higher percent. Of course, there's a lot of concerns on the market, and so that's why we've seen things like gold do pretty well. Here's gold. That's actually, let me just get rid of that that little note there. Hey, we're off the highs. This was an all-time high on gold about, I think that was Monday. we hit that all-time high. We've settled down a little bit. That's just showing, I think, some easing in the market, maybe some profit taking. Is that a way of thinking of it on gold? But in terms of the general trend, gold has been an asset class that has outperformed. This year, last year, gold has outperformed. Kind of historically, when you've looked, gold hasn't fared as well against equities like large caps. But, you know, every dog has its day, so to speak, and gold has certainly been having its not just day, but its year or last couple years, definitely on that. On the other hand, you know, if we look at other areas that, you know, these are futures contracts I'm looking at. We're not talking about futures trading today there, just to try and give us the price of the underlying commodity. Here's oil. Oil's gotten, you know, beat up. It's gone up a little bit. We're starting to see a little bit of a recovery on oil. We're right below that 20-day. And why is oil going down? Well, a lot of it is probably a demand side issue of people are concerned about economic growth going forward. And typically oil prices go up when there's more expected economic growth and demand. Energy demand kind of corresponds to that. If expectations went down, then this has gone down. But again, things are looking a little better. Energy, by the way, has been, we'll get to sectors a little later, but energy has been the worst performing sector over the last month, I believe. So that's, gold doesn't always go in line with energy, but obviously it is a big component of energy there. I do want to talk about earnings here in just a bit because we've started out, we're near the beginning of earnings season, and that's going to be a big factor in the market. But before I do that, there's one other kind of macro thing I want to look at, and that is I want to look at, sorry, I'm typing this ticker wrong, the 10-year and other interest rates as well. I always bring up the 10-year, but we can look shorter term and longer term, and we'll talk about that because how they relate is significant as well. The 10-year spiked, but we're actually back down under 4.3% on the 10-year. So that's probably, I think for a lot of traders, that's a good sign. It could be a lowering of interest rates could be a bad sign too, though. I know it seems like most people are kind of rooting for lower interest rates because, let's be honest, there's a lot of companies that do better with lower debt financing costs. There's a lot of homeowners that do better with lower debt financing costs. But if energy were to tumble, that may very well be a sign that, did I say energy? I meant interest rates. If interest rates were to tumble, that could be kind of a bad sign of economic concern about the economic future, that the Fed may be forced to try and spur the economy on. So a nice slow easing of interest rate may be preferable, maybe a better sign than a quick drop in interest rates there. Okay, so that's something you can look at. Let's look at this. A probability trader, why is CL down? Well, we just looked at CL, and I was saying it was demand. Today, it's up a little bit today, but in general, going back to what I was just talking about, probability trader is generally, if there's less economic demand or forecast for economic demand, that tends to hit oil prices negatively. Plus, there seems to be plenty of supply. There's the demand side, there's the supply side. I would argue most of the drop in oil has been on the demand side of things, but there certainly seems to be plenty of oil being pumped and refined right now, so that's not an issue there. So here's the 10-year. Do you know you can look at different rates though, instead of TNX, you can go TYX CGI. That's the 30-year, okay? That's the 30-year. So, and that's up about 4.7%. You would expect that to be higher than the 10-year. That's a normal yield curve. That's how that is. You could also do something like IRX. See if I can do this. IRX. You can also use this future, do this with futures, by the way. This is the 90-day, excuse me. 3-month interest rate, 4.1. Not a huge difference between that and the 10-year. In fact, you can do, by the way, you can always do kind of like a yield curve if you want. So what you would do is you could do TNX colon CGI, and then you do a minus sign. And that's going to give you your yield curve. Let me go out a little bit further. Let's go to 3 years here. And this is taking the interest rate on the 10-year, and it's subtracting the interest rate on the 3-month. Normally, the 10-year is going to be higher than the 3 months, so it's going to be a positive number, okay? By the way, you could do the same thing with like futures, /10y minus /2yy. But here's the point. I'm going to draw a line right where the 0 is. You may have a little hard time seeing the dashed line on my graph where the 0 is. Anything below that line is an inverted yield curve. That's traditionally not a good sign. That is kind of a sign of unease about it. We creeped out of this, we creeped out of that, and then we've kind of declined. We're still positive, little bit positive. So that's, if this were to dip down, that would probably be a sign of declining economic health, is the way I would say it, okay? It's not a guarantee of a recession or whatnot. I don't know, there's a lot of prognosticators forecasting a recession out there, but not everyone. And it's certainly not a sure thing of what's going to happen. Who knows? But right now we're at a positive yield curve. You can always do that, not just for yield curves, but if you ever want to take the difference between two different securities or indexes, little minus sign is the key to that. Let's turn our attention to the earnings calendar, because we have a lot of earnings coming up and we've had a bunch come out. Let me hit the calendar coming up first of all. Here's the calendar. I have just S&P 100 stocks. Excuse me, we're just narrowed down to S&P 100. Nothing today. Tomorrow, not tomorrow. Excuse me. Monday, let's see, today's the 18th, 19th, 20th, 21st. Monday, nothing. Tuesday is when we start to, so now you're going to start to see, this is next week. We have companies like General Electric, 3M, Verizon, Tesla, Capital One Financial, AT&T, Philip Morris, General Dynamics, Boeing, Texas Instruments, IBM, Dow Chemical, Pepsi, Merck, Bristol Myers, and more, including, sorry, those were, I was reading the wrong date. Today's the 25th. Today's the 25th today. What was I saying? Sorry, I was off on that. 29th. Okay, I was starting to see that. I'm all, wait, Google's already come out with earnings. Alphabet's already coming out with earnings. I realized my mistake there. Thank you. Let's try this again. Today's the 25th, 26th, 27th, 28th, 29th is Tuesday. Okay, so here we go. Next week, I could do the same thing. Honeywell, Kraft Heinz, Pfizer, Philip Morris, PayPal, UPS, Mondelez, Starbucks, Visa, Caterpillar, Meta, Microsoft, Qualcomm, The list goes on. McDonald's, Apple, all next week. Okay. Amazon next week. So, you know, earnings can affect the market. Right now, if I were to say what the biggest thing on the market is it's hard to, thing that's affecting the market. To be honest, it's news. And I can't tell you what the news is, or else it wouldn't be news. But particularly if it comes into account, like with when we start talking about tariffs and stuff like that, that is moving the market a lot right now. That's the number one thing moving the market. But there's also economic reports. We're going to talk about that today in just a bit. And also, there's also earnings, especially these big company earnings. Well, the biggest one we've had so far, I would say, came out yesterday. And that is Google. So let's go back and pull up, I say Google Alphabet. There we go. And we're up 1.6% today. They actually had a wildly good earnings, a really good earnings. Earnings per share came in at $2.81 a share versus an estimate of $2.02 a share. That's like knocking it out of the park, folks. That's a really good earnings report that we had on Alphabet there. And in association with that, JP Morgan raised the price target to 195 from 180. Price target was there. They moved it up a little bit. Okay. UBS raised the price target to 186 from 173. Wells Fargo raised the price target. Piper Sandler raised the price target. Bank of America, Bernstein raised the price target. So that is, let me go back to this chart and you can see today's action. So we sold off a little bit from the high, but it was a gap up. It was a solidly nice earnings on Alphabet today. Other companies that just came out with earnings here. Colgate, okay, came out with earnings. Up 1.3%. That's good. Nothing to sneeze at. T-Mobile came out with earnings. Down 11% today. Okay. And by the way, if you ever want to well, why is it down 11%? Sometimes there'll be a clear cause. Sometimes it's a little harder to discern. But what I would suggest is check out the live news and you can read. You can say, look, T-Mobile beats estimates. Well, that tells you that the earnings number is not the thing. It's other stuff. Let me click on that. Brings this up. But customer growth leaves consumers wanting more. You can read more. I'm not going to read it all right now, but their customer growth is bad and they got whacked today, 11%. So another one company that got hit today, INTC, Intel. Intel down 6.7% today. Okay, so those are some of the bigger companies that just had earnings. And of course, earnings aren't the only thing that drives the market. Other things that drive the markets are just general news. One bit of news, AAPL, was Apple. Apple announced that they were going to be shifting their plans were to import most of the iPhones they sell from India starting the end of next year, or by the end of the next year, accelerating a shift from China. They were already doing that to some extent, but certainly the policies and talk on tariffs are accelerating their process on that. So how'd the stock react? Not a huge reaction on that, but that was kind of big news in the market today. But it does kind of show, that some companies are trying to react to a changing economic global environment. Now, coming up next week, we mentioned earnings. We mentioned some of the companies that were coming out with earnings. We've got some big economic reports. Now, next week was a big economic week. Tuesday, JOLTS report. That's a big report. That's an employment report, job openings, labor, and labor turnover report. ADP employment on Wednesday. Advanced GDP on Wednesday as well. What's advanced GDP? GDP comes out quarterly, okay? But the way it does it is like in January, well, let me say this. So in February, you get January's numbers. And those would be like the first stab at the numbers. February, March, you get a revision on those. And then March, April. In April, you get what they call the final GDP. So this is final. This is advanced, number one. Okay. And I don't remember what they call this is just like revised or something, number two. Well, come then, so that's for quarter one. For Q2, April, May, we got May. We get the first one out, which is the advanced numbers for Q1. The most meaningful GDP numbers are the ones that are the advanced, because those are the most uncertain. Once you come out with advanced, then it's more tweaking those numbers. So that tends to, my point is, that tends to move the markets more, that advanced number. So that's a big number coming out next week. We also have PCE. That's an inflation report that comes out on Wednesday. Thursday, ISM manufacturing. We have our weekly employment report on Thursday. We also have the unemployment rate coming out on Friday. Another big number, non-farm payroll, non-farm unemployment report. That's on Friday as well. Huge economic report. So throw in big earnings, including most of those Mag 7 next week. Those economic reports I just mentioned, plus what's coming forth in the news, I don't know. We'll have to wait and see on that news what comes out, because we can't anticipate it. We don't know what's going to happen, but there we go. Okay, let me just finish up with this, because I'm just about out of time. This is a half-hour session on Friday. But here's a percentage change today. What did well today? Discretionary did well today. Okay. IT did well today. Communications did well today. Those are more cyclical type sectors. Okay. Defensive sectors are like consumer discretionary, utilities. They were down more at the bottom of the list. But that's very different than what we've seen year to date. This is a percentage change year to date. Consumer discretionary has been down 13% year to date. IT, 11% year to date. Those have been by far the biggest losers. Are any sectors in the positive year to date? Yeah. Staples, utilities, healthcare, the traditional defensive sectors are the ones that are actually in positive territory for this year. Okay, so the market is shifting. Sector performance is shifting. We'll keep an eye out for that. Now, I want to wish everybody a wonderful weekend ahead. And I want to thank Cam for helping me out in the chat. Always, Cam's great. Make sure you follow him on Twitter at Cameron May CS, my Twitter handle or X handle at Brent Moores CS. And that's it for the week. All right, everybody, have a wonderful weekend, and we'll see you again same time next week. Bye bye, everybody.